Hello everyone and welcome to this video where we will be discussing how to start investing, the different types of investment vehicles, risk management, and how to create a diversified portfolio. Number 1. How to start investing. A. Determine your investment goals. Before you start investing, it's important to determine what you want to achieve. Are you looking to grow your wealth over the long term or generate income in the short term? B. Assess your risk tolerance. Different types of investments come with different levels of risk. It's important to assess your personal risk tolerance before you start investing. C. Create a budget. Make sure you have a solid financial plan in place and determine how much money you can afford to invest. D. Build an emergency fund. It's important to have an emergency fund in place to cover unexpected expenses before starting to invest. E. Educate yourself. Investing can be complex, so it's important to educate yourself on the different types of investment vehicles, risk management, and diversification. Number 2. Types of investment vehicles. A. Stocks. Stocks are a type of security that represents ownership in a corporation. When you own a stock, you are a shareholder in the company and have the potential to receive dividends and capital gains. B. Bonds. Bonds are a type of fixed income security. When you invest in a bond, you are lending money to a government, corporation, or other entity. In exchange, the borrower promises to pay you interest and repay the principal amount when the bond matures. C. Mutual funds. Mutual funds are professionally managed investment portfolios that pool money from multiple investors. They offer diversification and the opportunity to invest in a variety of stocks, bonds, and other securities. D. Real estate. Real estate investments can take the form of rental properties, real estate investment trusts, REITs, or crowdfunding platforms. Real estate investments offer the potential for steady income and long-term appreciation. E. Exchange-traded funds. ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. F. There are many other types of investment vehicles as well, including exchange-traded funds, ETFs, commodities, and alternative investments. Number 3. Risk management. A. Diversification. Diversification is a risk management technique that involves spreading your investments across a variety of different assets. This helps to minimize the impact of any one investment on your overall portfolio. B. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the current market conditions. This helps to average out the cost of your investments over time. C. Regular review. Regularly reviewing your investments and making adjustments as needed can help you stay on track and make informed decisions. D. Keep an eye on market conditions. It's important to stay informed about market conditions and make adjustments to your portfolio as needed. Number 4. Creating a diversified portfolio. A. Assess your investments. Take a look at your current investments and determine what types of assets you already own. B. Determine your asset allocation. Your asset allocation is the proportion of your portfolio that you allocate to different types of assets, such as stocks, bonds, and cash. C. Consider your investment goals. Make sure your investment choices align with your personal investment goals and risk tolerance. D. Rebalance regularly. Over time, the values of your investments may change, causing your asset allocation to become unbalanced. Regular rebalancing helps to maintain your desired asset allocation and minimize risk. In conclusion, starting to invest involves determining your goals, assessing your risk tolerance, building an emergency fund, and educating yourself. There are many different types of investment vehicles, including stocks, bonds, mutual funds, ETFs, and real estate. Risk management involves diversification, dollar cost averaging, and keeping an eye on market conditions. A diversified portfolio can be created by assessing your investment mix, rebalancing regularly, and considering working with a financial advisor. Thank you for watching and I hope you found this video informative. Don't forget to like, comment, and subscribe for more helpful content like this.